Hello everyone, and welcome to the OCBC House View video series. As we enter the second quarter of 2024, market volatility has surged. Investors are recalibrating their expectations on the Fed rate cut following the stronger than expected US job market data and inflation data. In addition, heightened tensions in the Middle East have pushed oil prices higher, adding complexity to this inflation fight. The US dollar has extended its strength while the Asian currencies have weakened across the board. China's strong growth in the first quarter remains an idiosyncratic event. In light of these recent developments, the OCBC Global Market Research Team has updated their calls for the key economies and asset classes. In this series of videos, we will be providing the updates to our audience. Arguably, the trajectory of the oil prices will play a pivotal role in shaping our central bank call this year. In the first part, my colleagues Jonathan and Enver will share their insights on the commodity market.
Today, we have our commodities analysts Jonathan and Enver joining us to share their insights on the outlook for crude oil and crude palm oil respectively. With the recent developments of growing tensions in the Middle East, I'm sure that investors are anxious to find out how this affects the crude oil market. So Jonathan, could you describe to us the recent developments in the global oil markets?
Indeed, crude oil prices are higher by 13% year-to-date, with Brent touching $92 per barrel. This is being driven by escalating geopolitical tensions. The situation in the Middle East has reminded us that the risk of a broader regional war cannot be entirely ruled out. Direct attacks over the past week putting global markets on tenterhooks. On top of this, fundamentals have tightened. And by fundamentals, we mean a tighter supply of physical crude oil that is available in the market, as OPEC Plus extended its additional cuts of 2.2 million barrels in the second quarter. Meanwhile, demand has been more resilient than we had initially expected, driven mainly by still resilient US economic growth.
So, how does this affect our house view on oil prices?
We have revised higher our crude oil forecast by 6%. We now expect WTI prices to average $79 per barrel versus $74 per barrel previously. And for Brent, we expect an average of $85 per barrel compared to $80 per barrel previously. In the near term, we see oil prices remaining elevated but should come off from recent highs. Moreover, we see prices peaking in the third quarter as the fiscal deficit is the widest during that quarter by our estimates. As you head into the fourth quarter, we anticipate some moderation in oil prices as the physical oil deficit narrows from moderating global demand. In terms of risk, geopolitics are something that we should monitor closely, particularly events in the Middle East. Our baseline does not reflect a widening of the Israel-Hamas conflict into a broader regional conflict. If that were to happen, we foresee oil prices spiking above $100 per barrel. Specifically, we expect Brent oil prices to touch $120 per barrel and remain at elevated levels until a clearer resolution is in sight.
Thank you for your insights, Jonathan. Moving on to crude palm oil, Enver. Crude palm oil prices have seen a similar bullish run since the beginning of this year. How sustainable do you think these price movements are? And what factors are we looking at going forward?
Yes, Ian, we did definitely see some similar bullish trend for the CPO prices so far this year, with the benchmark CPO price having risen by at least 12% year to date and currently still trading above the 4,000 ringgit per metric tons. Most of this uptick, we think, still reflects concerns of subpar production levels from both Indonesia and Malaysia, the main producers of CPO. And in addition, demand was higher earlier this year due to several festivities that took place, including the Lunar New Year, Ramadan, and Eid festivities. So looking ahead, we believe that prices are ripe for pullback, with prices expected to come down towards the end of the year. Firstly, production levels are expected to improve as El Nino-related disruptions subside. And indeed, the intensity of El Nino phenomenon has dropped dramatically in the past few weeks. Secondly, labor conditions in Malaysia's plantation sector are expected to improve further as the government has recently allowed the hiring of foreign workers. And indeed, the Malaysian Palm Oil Association chief noted earlier this year that if the industry shortage of 40,000 workers is addressed, it could increase Malaysia's CPO production by up to 1 million tons this year. And thirdly, the passing of Lunar New Year, Ramadan and Eid festivities means that demand is expected to normalize and potentially even moderate towards the end of the year. Finally, CPO's discount compared to rival vegetable oils such as soybean oil also continues to narrow. This means that CPO will not be as attractive as a substitute to soybean, potentially reducing its demand to some extent. We are therefore maintaining our forecast for CPO prices to average 3,650 ringgit per metric tons this year. However, we remain mindful that there is some upside risk to CPO prices, especially if production remains low as a follow-through of the recent El Nino phenomenon.
Thank you both for your insights. This will conclude our segment.